This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we're very pleased to welcome on Ian Reynolds with Sabrea Capital. And the topic of conversation is going to be a little bit varied, but it is extremely topical for our listeners. It's tough to say that anyone of a certain age probably isn't watching the news in some form or fashion, especially here in the United States and abroad with what's going on in Eastern Europe, the Middle East, especially with different economic policies here in the U.S. driving a lot of other, economic unrest and uncertainty. There's a lot to kind of unpack there, but at its core, it's something we need to be focused on, especially as it relates to how it's going to affect your ability to invest, where your money is going, how expensive things are going to be getting. But understanding kind of what all that means is the tough part, right? You hear one thing from somewhere, you hear another thing from somewhere else, but how does all of this kind of coalesce into something that is digestible enough, right? It's not something that you're going to eat in one bite. It's going to be a meal. And it's going to be something that you really kind of need to take in several different angles to kind of understand what some of these drivers are, especially when it comes to economic policy of different countries as it relates to foreign exchange rates, inflation, central bank policy, bonds, digital assets. It's a lot to kind of get through, but we're going to kind of hit some of those high points and lead on Ian's vast experience in these different sectors. So Ian, again, thank you very much for being on with us today. If you wouldn't mind, give us a little bit of background about yourself, because people that are ingratiated into these types of market sectors typically have a little bit of an interesting origin story. So we'd like to hear a little bit about kind of how you became to be in your current position and how you became to be involved with some of these kind of things.
Sure, and thanks very much for inviting me on. So I started my career in 1988, back in the day, after Margaret Thatcher deregulated the London market and a whole wave of American capital came in. So we all had a rather wonderful time back then. So I started off as a junior bond trader at Manufacturers Hanover in London, which has now been absorbed by Chase and whatever it's calling itself now. I then moved to Bank of Nova Scotia, which is, as you know, a big Canadian bank, where I was a money market trader and then a foreign exchange trader for most of my career. After that, I traded my own money on the London International Financial Futures floor. So I've been a pit trader. And then I ran a prop desk for a Kuwaiti bank before supposedly retiring. So I met my wife in the bank in London, and she's Australian. So we went to Australia and had 6 kids. So I promptly had to unretire myself. So in Australia, I've been trading my own money, and I've been investing in tech startups and in digital assets. A relatively early investor to Bitcoin, 2016. And in 2009, after the GFC, I realized that things were going to go horribly wrong with money, all the money printing, obviously massively compounded by COVID. And here we are at $37 trillion in debt and a big problem to solve. And I thought 3 years ago, I'd start writing some content around how I can help people understand what I believe is going to happen. And that's called Limit Up, and it's available on LinkedIn.
Fantastic. Definitely interesting story. So you actually got to do did you get to do real open outcry trading on a trading floor?
Absolutely. Absolutely, I did. And it
Oh,
was
that's
with my own
awesome.
money, which was even more scary.
That's awesome. I've met a few people that actually have gotten to do real open outcry, and it's for people who aren't aware, if you ever see a movie that stock market with all the traders doing the hand signals and shouting and all the paper flying on a trading floor, that's open outcry trading. It's something that really is a thing of the past for a lot of different financial markets. But whenever you get to meet someone that was actually doing it, pick their brain, sit down, buy them a beer, buy them dinner, because it's a fascinating kind of part of history that's really kind of going away, and getting to talk to people that have done it is something I really enjoy. I think you're maybe the fourth or fifth person that I've gotten to meet that's gotten to experience that part of being in the financial market. So thanks for thanks for being on here today. So let's kind of go back a little bit, because I think a lot of these different monetary policies that are really driving some of the issues and some of the markets that we're in today started back around the GFC. I mean, that's also the time that you really have the first white papers. I mean, Bitcoin kind of coming onto the scene. You have digital assets getting their birth. You have a lot of monetary policy coming in after the GFC and what countries were doing that are driving a lot of the things. Again, some problematic, some not so much, but again, the general place that we're in today, really kind of bears looking back a little bit. So, what are kind of some of the things that we're starting around that point that you really identified that people should be kind of aware of and how they function in today's market, especially as it relates to things like foreign exchange markets?
Yeah, so actually, I think it really started after the dot-com bust,
Okay.
um, and really accelerated after the GFC. And when you start manipulating money, funny things happen. And unfortunately, the regulators can kick the can down the road for an awfully long time. And as we've seen from Japan, you can monetize the debt, i.e., the central bank can buy an enormous amount of a government's debt. But when you're the reserve currency, it makes it really, really hard. And as US government has become more in debt because of obviously continual deficits fueled by that very reserve currency status, then years and years of deflation and low interest rates have completely distorted financial markets. So when the unwind happens, it's going to be huge. And so all that's led to the recent leg down in the dollar. So let's say 15% loss in the last 6 months or so. For a reserve currency, that's huge. Is that good? Mr. Trump thinks it's great, but any excessive move can have very big repercussions. So everything has kind of been building up ahead of steam. And as all the money printing and the deficits and the debt increases and we hit COVID, it goes completely bonkers and out of control. And if you look at how financial markets are operating and reacting, what they're reacting to at the moment, they're not interested in wars in the Middle East or in Europe. They're only interested and sensitive to the debt and ability to repay by the United States.
Sure, and I mean that's a direct, kind of at at a broad construct, a kind of health marker for the U.S. bond market, if you will. People kind of looking at that from the perspective of hey, here's how our dollar's trading. But I think a little bit more of a good litmus test to see how our debt is trading, right? To see how that the effects of the continual money printing and that policy kind of drives the desirability of our debt. And you've seen that. You've seen directly with rating agencies even starting to take a stronger look at certain debt instruments of the United States government. It's, canary in a coal mine to a point. There are things that can be done to kind of right that. But looking at some of these markers, especially, I think is very important. Now, going back a little bit, I think the valuation of the U.S. dollar is kind of an interesting question to expound upon a little bit because forever and a day we have for more than one generation been the reserve currency of the global financial market, with a few exceptions of people that don't like the United States that much. Typically have always pegged everything against the US dollar, whether that be for just the underlying liquidity of almost any market, whether that be for international wire transfers. It has been that standard. Now, that has, the US dollar has certainly been in flux of its value, just like any currency over time, right? It's not a static figure, it's going to fluctuate up and down. But with a continual kind of repression of that value, at least over the past however many months, I mean, to your point, I think you said, what, 15% down from its last up marker. Where do you kind of see this going? Because I think the fear for a lot of people is that, and there's been rumblings of it happening, is that the global reserve currency is shifting to another platform, right? I think that's, not necessarily even in the realm of something that's symbolic to say anymore, but certainly not something that's going to happen tomorrow. But what are some things, maybe the question being, what are some things that you feel are going to continually drive that valuation down and that rhetoric, for lack of a better term, that, kind of the voice of changing that up, and what are some things that could potentially maybe right that ship?
So I think the path of the US dollar is going to be lower, but it could go higher first. I know that's not very helpful. So the process of de-dollarization, I believe, is much further advanced than people want to believe. I think at the weekend there was a report in the Wall Street Journal about African nations having their own settlement platform, as Russia wants to do with China and all that stuff that you know about. But the problem is that all of the debt outside of America has to be repaid as it becomes due. And if you want to de-dollarize, you take that opportunity to pay back your US debt and borrow in yuan or whatever it is you want to borrow. So there's this continual, it's going to be this continual desire for dollars just to get out of the debt. And as rates go higher, then obviously the desire for other people to get out of the debt is quicker. So anyone that thinks that the dollar is going to zero tomorrow, I think is going to be very disappointed. It's currently looking at a level on the Dixie, which is the US dollar futures, of it's currently 97, so it's looking at long-term support at 94 to 96. So it has nearly reached long-term support, and I suspect it's going to bounce off that and at least stabilize for a bit. And as things get worse for the US fiscally, there might be a big lot of dollar buying to get out of debt before bonds really crash. And then there comes a time when all of that is over and there's nothing left. Does that
Sure.
help?
No, it definitely does, and it brings up a couple interesting points because, you have this, status of all this, all these bonds and all these different debt instruments being held externally from the U.S. And if you want to get into another base currency, well, you have to get rid of that, right? You're not going to come back to the central bank of the United States and say, hey, here's my pound sterling, or here's my yuan, or here's my dinar. Like, you're going to pay us back in the base currency of whatever that debt was written in. So you're
Yep.
going to have that kind of interesting influx. And that's not a point that I've really heard, spoken about. And I think that's a really interesting thing to look at. So from the perspective of, kind of that money velocity, if you have people that are really kind of trying to churn that debt out and get out of that, it certainly is going to probably, again, not only prop up the value of the dollar, but probably prop up the ratings of our debt, at least in the short term. Do you think that there is some type of opportunity that can be used at least to maybe passivate the markets and maybe try to right the ship if you have that going? Or once that starts to happen in mass, is it one of those things where it's really kind of a bad situation that you have to look much farther and much bigger in order to stabilize that market?
Yeah, so I think that the US Treasury is doing a great job, and they've been landed in a really bad situation by the previous administration. So they're trying to manage, you know, 4.35% 10-year yields, and $37 trillion of debt and a ballooning budget deficit. So in terms of how they manage it, they're doing a really good job and they're talking the right talk. But unfortunately, when you overlay that with tariffs, everything becomes very confused. And when you overlay that with the big, beautiful bill, which is saying, oh no, let's have more debts that we can issue, and let's allow the budget deficit to get larger, and let's cut taxes, it doesn't really add up. Can you please at least give us a timeline or an order in which those things are going to happen? And Mr. Trump's not very good at that because he wants to do everything immediately right now, as we've seen in the tariff stuff. So whereas Scott Bessent is doing a great job at talking the market his way, he hasn't been able to get those rates down because of the confusion higher up in the chain from Mr. Trump around those things I just mentioned.
Sure. Now, from the perspective of that, and I think that's kind of a good place to come back into with regard to, for people that aren't necessarily inherently very familiar with the US how monetary policy is fleshed out, you have the central bank, the Fed, that kind of writes monetary policy of the intrabank lending limits, how we try to interact with the world and try to stabilize those markets to get long-term effectual growth and stability from our markets. And then you also have the legislature for three branches of government that interact to more immediate policy with things like trade, taxes, things like that that will affect us more domestically. But to say that the two are divorced is just a flat out, just falsehood, right? They interact very very closely with each other, and especially as it relates to things like tariffs, which bring to bring it to a little bit of a closer examination, to bring it more broadly when it comes to this, fine dance that we have of, I think the important thing is keeping the US dollar as a reserve currency for us, at least. No other nation really kind of has that problem or benefit, depending on which way you look at it. But for us,
Yep.
it being inherently important to do for everything that we do, where does, like, how much effect does external monetary policy and internal monetary policy affect that? Like, what are some of the big drivers that are, past just the uncertainty of everything that is going on, especially with the kind of points you made about the repayment of debt? What are some things that, these larger policies of either domestic or foreign governments have? And what are some of those things?
So interior policy, obviously very important, and the Fed still has credibility with markets, but that seems to be waning. Mr. Powell seems to be having a big punch up with Mr. Trump, and currently at least two of the Federal Open Market Committee members are saying they want to cut rates as well as Trump. So you're seeing the beginnings of a fractured Fed, which is really bad for the dollar. Confidence, as you know, is a very fickle thing. And if you're going to be in the financial mess that the US is in, you want to have all of those regulators fully aligned with trying to solve the problem. And you can't have your president tweeting or doing social media posts that your central bank governor is not capable of doing the job. And markets have kind of been able to wash over that for the moment because we have these wars that are in our focus. But it will come down to, where is the plan? You've had 100 days plus 30 days or whatever it is now, and you still haven't achieved anything. Where are we going with this debt? It's still at the same rate, 10-year yield. You've had one failed 20-year auction, which is never a good confidence booster. All these foreign nations are kind of hanging there with their US debt because they have bought those dollars to sell in the foreign exchange markets if they need to support their own currencies. But it's a very fine line between being confident in the reserve currency and not. So external issues are kind of less important. But of course, with any currency pair, there are two currencies involved. So the relative value of which is generally a difference in interest rate, political risk, all sorts of stuff. It's really complicated, and it comes down to people like me putting a price on it. But if we've seen in Japan recently that they've had to overhaul the government bond market and try and invent some new ways to support it, and they're very much in a worse situation fiscally than the United States, but they don't have to care so much because they're not the reserve currency. They still care, and they still have to fund enormous debt to GDP ratio of 250% compared to 120% in the US. So those external factors are very important, and we want the US dollar lower, according to Mr. Trump, for the purposes of exporting more and importing less, which is great. But you don't want it to go down really quickly. It's gone down quite quickly so far, but a sudden shunt lower brings into view how confident are we of buying this stuff, because normally when we don't trust the currency, those rates go up a lot, and we don't want to be in the situation where that is happening, where you have a massive haircut on bond purchases for foreign investors.
No, and that's a good point as well. So it's not only necessarily kind of the repayment, but it's also the consumption of the U.S. debt that's important, right? If we have continually run a deficit and issue bonds to pay for our budgetary needs in the United States, well, that's well and good, but you have to have a counterparty to it, right? This stuff doesn't happen in a vacuum. If you have a market for the debt, okay, great, but continuing to hope that remains at the same level, and then also further to that, the secondary market of how these things interact globally is very important. I think kind of what I'm hearing from you is that you know it's more of a velocity issue than it is so much of kind of the immediate policy issue, right? Like this stuff can happen, it can be massaged, it can be changed, it can be either a net neutral or maybe some positive or maybe a slight negative, but it's the velocity at which this stuff happens that is kind of the more concerning factor, at least in the monetary markets right now. Is that more or less kind of a generalization that rings true?
Yeah, no, that's a fair comment. I mean, if you look at what happened in the UK 2 years ago when Liz Truss was the Prime Minister and the Bank of England's trying to raise rates, but they're trying to cut taxes. And because the market realised that Liz Truss and Kwasi Kwarteng, who was the Chancellor of the Exchequer, they didn't know what they were talking about financially. Gilts crashed, sterling crashed to an all-time low pretty much. And big problem for pension funds in the UK, some bailing out of them, and cost to average pensioner of a lot of money. So it's a really fine line between trust and not.
Yeah, I recall that. I was in the UK around the time that was happening, and I just assumed from my previous trips it was like 1.8 to 1 to the US dollar, and I go over there, I'm like, I think it's so much cheaper. This is absolutely not good for anyone
Well,
except for me traveling as a tourist, but
that's
it
right.
was certainly surprising because that happened so quickly that I was shocked when I was over there for a week. It's interesting to see how fast that stuff can run, and then to see the kind of ripple effects that has had to still what is kind of happening with the UK Parliament and monetary policy has been interesting to watch, because again, these things can happen fast, but the resolution of some of these issues can take a very long time, which is the concerning part about it, right? You have these kind of paradoxical shifts that can happen very quickly, but picking up the pieces, solving everything takes time. And that's where my big concern comes in, is that the short term is going to be the short term, right? You've invested soundly, if you are making good enough decisions, the short term is easy enough to weather for people that are making solvent decisions. But it's the long term that is the big unknown that really kind of frightens me um, to a point when it comes to a lot of these markets. One thing that I kind of want to get your pulse on as well is that, unlike in previous iterations of different glo- domestic and global monetary issues that we've had, think savings and loan, think .com, think the GFC, we haven't really had too much of an alternative investment pathway forward like we do now with digital assets. And that's something that I find interesting to see how it's going to kind of play out with regard to, again, these broader issues when it comes to foreign exchange. Is now you have a new decentralized reserve of value. And I hesitate to use the word currency. I look at it more of a value reserve for this decentralized market. How do you think that's going to kind of play into what's going on? And can that be a hedge for people? Will that help to stabilize, or is it going to be something that's a little bit more disruptive, you think, to what's going on right now with, foreign exchange markets?
So if there's a global sovereign debt crash, then basically the purchasing power of all currencies goes to zero. And we know that every fiat currency that's ever existed has gone to zero. So we can't really expect that not to happen over maybe a long period of time, of course. But the point is with Bitcoin, and we'll say Bitcoin as the biggest digital asset, is that it's not related to any country or any financial system, has its own inbuilt monetary policy. So it is to some extent like gold. Lots of people think it is digital gold. It's not digital gold yet because it doesn't really trade like it, but it's getting there, and it's a new technology. So it's um, the amount of people using it is growing faster than the internet. So it is a great monetary hedge as currencies go to zero. Because if you look at the last 30 years, the pound, the dollar, pretty much everything in terms of its purchasing power is very, very, very low, kind of like 1% of what it was. So if that keeps playing out, then Bitcoin by definition is going to get a lot stronger because it's priced against a fiat currency. So yes, there are those things, but there's also gold and silver and whatever. But I think digital assets, because they can be non-sovereign, are a great place to at least store some of your fiat currency in case the worst happens.
Yeah, and it's, from my perspective, it's something that's a really interesting kind of evolving case study, and rarely have we gotten to look at something, from that has this much information this closely since inception, right? You look at any major governmental organization. I mean, the U.S. dollar has been around for several hundred years. The pound even longer. Other currencies have cropped up, but take the euro with the coalescing of the European Union. Um, you know, Rarely have you gotten to see something with as much information like this, that again, I hesitate to call it a currency right now. Again, I view it more of a, like you said, like a more of a gold or a silver, kind of that hedge of an asset, right? It hasn't, a currency needs to be something that is readily usable in almost any market that you go to, as far as an exchange of value for goods, right? It needs to kind of get to that point where it can be utilized as fiat is in today's world, right? You're not going to go to Central Africa and, pay for something at a market with Bitcoin right now. I mean, typically that might be able to be the case in the future, but it's not as readily exchangeable. But with regard to kind of the utilization, especially when it comes to governments, I mean, look at Central and South America. You have governments actually buying in tranche large portions of this. And was it Venezuela or Argentina that tried to, or is trying to, base a reserve backing on Bitcoin?
Well, El Salvador made it legal tender, didn't they, a couple of years ago,
Yeah.
and is still buying it. Um, so they are the Bitcoiners' ideal use case. Venezuela created their own digital currency after sanctions were applied. So that's kind of a different situation.
Okay, that's what it was. Yeah.
Yeah. And Argentina has played with it, but not really done anything yet. But certainly there are Middle Eastern countries that have put digital assets into their sovereign wealth funds. And I'm sure there are many we don't know about.
Yeah.
So as you know, as people start to get nervous, they start to have to diversify. And then as the situation gets worse, they have to diversify a lot. So I suspect that if the US can't solve the issues with debt, then that is only going to accelerate really quickly.
Yeah, and I want to come back to the solving the issues with that, 'cause I think that's a good kind of second half of this. But another interesting kind of perspective to take on cryptocurrency, or digital assets, I should say, is with the increased utilization, the increased adoption of this. You have something again decentralized from the federal market, the federal currencies of various nations. And when it comes to foreign exchange, you have to have a counterparty to buy it. I want to sell my British pounds for the euro or the dinar or the yen, whatever it happens to be. The markets, again, are all based around this centralized market of one government's currency for another government's currency. With, again, the instability in those markets, do you think that maybe there could be another external factor provided by digital assets to pull out some of the people that are as active in the party counterparty marketplace of the foreign exchange into more of the digital asset space, which could compound the issues that we're already seeing?
Yeah, so if you work at a bank and you're quoting in a wholesale amount, say $5 million or more worth of a different currency, then you don't run a book that is of a cross currency. So you wouldn't run a euro yen book. You would have a euro dollar book and a dollar yen book. So currently the US is benefiting through the global reserve currency status as having twice the volume for one trade, if you like, in that you
Sure.
have to trade out of both. So this is really keeping the US dollar in the system and the system totally dependent on that US dollar. So as digital currencies become more liquid, and currently in London time, $4 trillion worth of foreign exchange is done every single day. So you have to have a significant increase in trade in a new currency. I called it a currency, in a new digital asset
Yeah.
to take over the sheer volume that is already set up. So that's
And
going
I
to be super difficult.
Yeah, and I think that's a really good point to make, is people understanding again what reserve currency means, right? You know, if you're again to that point of quoting wholesale books, you want to go from pound sterling to yen. Well, you first go to the dollar and then exchange out into the yen. I mean, it happens very quickly, but when you have a lot of instability and you have that base currency dropping 15% in as many months, it makes the price of that trade, go up by a multiple factor, right? That's what people want to avoid. That's why you want a more stable base currency. But again, to that point of $4 trillion of trades in a day, it really kind of shows how big that mountain is, right? People look at the new budgetary spending bill, the big beautiful bill that is, being pushed through the U.S. government right now. I can't remember the exact figure, but I think it adds something to the tune of about $4 trillion to the national debt over. Do you know how many years that was? I don't quite recall the
I think
runoff.
it's meant to be 3 or 5 years, but at the current rate, we're not even going to bother the score at how long it's going to be, are we? Because it will be there pretty soon.
Yeah, exactly. But to that point, four trillion. Let's say call it 4 trillion over 4 years.
Sure.
That on the London markets is done in a day, right?
Yep.
That's how much velocity and volume is being traded in the U.S. dollar right now. So again, it looks big, and again, $4 trillion is huge, right? That's a lot of zeros, a lot of commas, and a number to add to anything. But when you look at just what's happening there, not including what's happening in the U.S. markets or what's happening in the Japanese markets or any of these other markets that use it as a base currency, again, I like to bring attention on this podcast to issues that go on with anything, whether it's people wanting to invest in a commercial multifamily apartment building in
Yep.
a developing market in the United States, or when it comes to foreign exchange, is that there are issues, but understanding how big they are, how fast they move, and where your concern needs to lie is important, right? There's a million meteors flying around space, but are any of us should we be concerned about them? Yes. Are any of them going to hit us? No. Be concerned, understand where the threats lie, and act accordingly. So again, I think that's a really good point. Especially with also how big cryptocurrency digital assets have gotten in recent years. It's in the news constantly. You constantly see it, but it is still small in comparison. I think Bitcoin's the only one that's eclipsed the $1 trillion market cap. I think Ethereum might be right behind it. But that market cap is 1/4 of the trading volume of foreign exchange done on the London market in a day, right? It's
Exactly.
just keep in mind, even though these are big numbers, there are much bigger ones out there.
Yep.
So,
So also to the flip side of, sorry to interrupt, the flip side of having $4 trillion worth of currency transactions going through every day, if there is a loss of confidence in the dollar, and nothing can take its place, then there's a really, really big systemic problem for the world.
Exactly, because that's the other question, right? People say, "Hey, let's get off of the U.S. dollar as a reserve currency." Okay, well then, what do you replace it with, right? What else has the volume? What else has the trading power of the U.S. dollar? Are you going to go to the Chinese yuan? Are you going to go to Russia? Or where's that going to come into play? I think people, it's the easy headline for the news agencies to say that, but on the reciprocal, it's like, well, okay, how do you fix it? Just like energy. It's like we need to stop burning fossil fuels. Okay, well, how do we make batteries efficiently, effectively, and cheaply enough to replace every single gas burning car in the world, and also the energy infrastructure that goes behind it? another conversation for another day. Something I'm kind
Yeah.
of passionate about.
And
Um,
then exactly the right
yeah,
simile, because every time we try and go off fossil fuels, something drives us back to it, right? Because it's a
yeah.
really difficult thing to do.
Exactly. And, it's between, like, how do we make this more efficient or, keep taking a look at nuclear, but people are like, oh, let's do that. It's like, well, it takes 30 years to build one of these plants. Like, there's no immediate fix for this. You have to be much calmer, much more strategic, much more forward thinking to really solve this stuff. And the problem is that people want to fix now. And those two things are diametrically opposed from each other, right? Like long-term stability fixes are not going to be what immediately solves an issue because those immediate solves are going to be what create and compound more strategic visions and things that can fix that. So, kind of leading into the next point, I wanted to kind of examine with you are it's all well and good for us to talk about issues, right? There's a lot of them; they need to be looked at. But what can kind of be done? What are some of the things that at least you would like to see happen, or maybe even like realistic things that could happen to kind of right this thing to a point where we can get to a position, internally in the United States, or I guess definitely more broadly globally, that could help to not, steer this thing right off of a cliff.
Well, so the problem is about debt. And what can you do about debt? Well, you can not repay it, or you can have a repricing. Um, so the problem is there are very little choices. So one of the things that has been talked about is repricing of gold. And we're not in 1971 or 1933 again. Markets are way more liquid and deep and are being used way more, as we've just discussed. So is that a way that things might happen? We could price gold, I think it's $23,000 per ounce would pay off the deficit, whatever the number is. It's miles away from where we are now. Is there a policy to get gold there? This continual manipulation of money has got us here to start with, right? I can't see that making gold instantly, let's say 10 times more valuable in terms of your fiat currency makes any good sense, because it just pushes your value of your fiat currency down to a tenth of it. So what can we do? Well, like you just said, we need to the Western world at least needs to have a strategic 20-year plan about how we're going to grow our economies so that the debt becomes minor in comparison to the tax revenue we get out of those economies. But the world is mired by the problem of 4-year political cycles and misaligned fiscal and monetary union. One great thing I think that could happen would be if the EU, and this is not a very popular opinion, if the EU actually became a state rather than a political framework, because the size of the EU economy is actually larger than the size of the US economy, but it's not a state, it's just an agreement between politicians. So I would suggest that the world has to refocus itself in terms of what statehood is and what it means. And that's a really big, deep change to start to happen. So 27 countries in the EU, would they all agree to that? Who knows? Would they agree to it in an extreme situation of a debt default by everyone? Maybe they would. I don't know. So I think that the problem is so big, only a really big idea is going to solve it. And a big idea needs cooperation from all those involved, which seems very far from about to happen at the moment.
Yeah, and I think I mean, it's an interesting, thought experiment. Again, I highly doubt with, again, the massive amounts of history that different, geographic locations have within the EU and, the thousands of years of again, just culture that you have. I think that it's an interesting thought experiment, but would it necessarily happen again? You know, Interesting to see because I mean, you take something like the default that happens in Greece, that has ripple
Yep.
effects. What happened in Spain, you have these things that send big ripple effects through the EU. But I think to your point, you would have to have several of those things kind of coinciding at one point for that to really take effect, to where you have, the Germans and the Dutch and the British and everyone kind of coming together to say, okay, well, this is going to drag everyone down because, hey, we're all in the same currency unit. And two, like, what's the best for everything? Yeah, it's definitely interesting to look at, but I would shudder to think about what it would take for that to happen as kind of the catalyst for something of that magnitude, right? Because I think you would have to have a lot of very bad things happening very quickly at the same time.
Well, when you think about what's happening in Europe, so you have something that doesn't happen in the United States because you're very lucky with being between two very big oceans, and that
Yeah.
we have Russia on our borders, right?
Yep.
And you know what's been going on in Ukraine, not to go down that rabbit hole, is really big for Europe, and
Yep.
lots of countries are very scared of that. So I think that actually the geopolitics of that could easily trigger a much bigger conversation. And who wants to join the EU? Well, Canada might, apparently. The UK might again. Who knows?
Yeah.
Greenland might, because the UK has got an option to buy Greenland. Who knows? But when really big things happen, you'd be surprised how we can come out of it.
Exactly. It's the unknown factor is also, fascinating to look at when you look at, some of these what ifs, right? What if this happens, going down the road, how is this going to affect everyone, especially from a market standpoint, I think is very interesting. And to kind of, again, since, most of our listeners are in the United States, to bring it back a little bit closer to home, that's definitely an interesting thing that I never really would have thought about, of, again, kind of the coalescing of the European Union into more of a statehood framework than a cooperative framework, if you will. Turning everything into one instead of, kind of like the United States is, a federal system of, things like that. But again, from the immediacy of kind of what we're doing in the United States, with the massive increase and or continual increase of our money supply, coupled with the instability of the foreign exchange, of the base currency valuations, what are some things, at least, that you see that might be able to be effectively, stem some of the bleeding if it were to happen, or maybe some things that are on the table right now that people should be paying attention to that could have a positive outlook on what's going on?
So Scott Bessent, do you call it? Do you pronounce it that in America? But
Yeah, Bethany.
anyway, he's got this idea that stablecoins can have a $3.7 trillion market cap in the in America, i.e., regulated by American regulators. So they would insist in some form that US treasuries are purchased to the value of the stablecoins issued, which would drive $3.7 trillion off the debt effectively, which would be a great thing. But the problem is the debt's increasing so quickly. You can't, and to try and coerce a fledgling market into that sort of volume seems difficult. The Treasury is doing a good thing at the moment, buying back its own treasuries with their own money. So it's not QE. They're just trying to stabilize the Treasury market, because in times of extremes, the off-the-run securities, i.e. the odd things that are left of a 30-year issue 27 years later, are the ones that primary dealers can't sell. So they're doing a lot of good things to try and stop rates going higher. But they need rates a lot lower. And I think that the Fed is just about to give them what they want if Mr. Trump can get Powell over the inflationary effects of tariffs.
Yeah, it's that's, again, I think you hit it right there. It's the big, looming thing that kind of drives all this, is that inflationary effect of tariffs, which, at least from my perspective on everything, and kind of talked about a little bit off air, is just that the lagging of the, like, the viewed effects. We have laden goods that have already come in pre-tariff. There's, you know, trade is not an immediate thing, right? Stuff has come in. We have
Correct.
to go through that supply before we see this repricing happen, with stuff, and that's gonna come. It all depends on kind of how sticky some of these tariffs are, and we've seen wild swings in all of it, right? So again, that's to that point. But to your interesting point about the stablecoin proposal, The big thing that I see of being an issue with that is the problem that the U.S. government has had in forming any type of concrete regulatory oversight of digital assets. And we've seen that problem crop up in a big way with things like unregulated exchanges like FTX, which again was a whole other thing to examine. I've actually done that on this podcast as well, with kind of a dive into that. But the need, as much as I hate to say it, it pains me with kind of my political views, is we need some concrete regulation and examination and oversight. I mean, I just tell people, imagine if you just removed all of the safeties and government oversight, you just fired everyone at FINRA, you sent the SEC on a year-long vacation, what would happen in the stock market? Nothing good. I can tell you that much. And you continually seeing bad actors crop up so easily in the digital asset space that to have that be an effective outcome, you need to have some concrete regulation, some oversight with people that understand this stuff and policymakers that can write real effective policy on digital assets. And that's a that's almost as big of an ask, if not, I think probably honestly a bigger ask than just that avenue of having that peg stablecoin. So I think until you get that framework to have that, again, it's just kind of, it's all well and good, but you got to have the safeties built into a market to create that kind of avenue. And I don't, and again, nothing that I've seen, and maybe you could speak to that a little bit here at the end. Have you seen any countries or different places have effective regulations that could be a mirrored framework for the United States when it comes to digital asset policy?
Yeah, no, not really. Here in the UK, we have a sandbox where you can test digital assets execution along with traditional finance assets, but we're still miles behind. Um, and all of the innovation really comes from China via Hong Kong.
Hmm.
So the Genius Act in the US is meant to give greater um, knowledge of what that framework's going to look like, but it's been written by bankers who obviously just want to keep churning in the money every day from transactions. So to get them to fully adopt, I know that JP Morgan's got their own stable coin and stuff like that, but I think to have a even nationally accepted framework, I mean, it's just such a huge job for,
Yeah.
when Bitcoin is the old guy in the room at 15 years old, right?
Yeah.
I just
Exactly.
don't think it's going to happen.
Yeah, and not anytime soon. And that's kind of the problem. Kind of going back to the theme of this conversation is, we have an immediacy need for economic policy and action items that can, again, kind of right the ship, if you will, to a point that we can actually get things repaired and sail it off in a meaningful manner. And to exactly your point, the people that really understand this stuff, you probably would have had to have been, let's say, 18 to 21 when Bitcoin first got adopted to really be to have the mental capacity to really kind of be able to develop along with it. Think back to when the advent of the personal computer, right? It wasn't a 5-year old sitting in a Palo Alto garage. It was, some teenagers and some people that could like have that development to think and understand and be long-term visionaries with it. I mean, those people are my age now, right? It's a lot of young people that either aren't in office, aren't in the ability to write policy, or aren't being asked for their ideas and input in a meaningful way. You have people that are inherently extremely familiar with traditional financial markets, which is great. They actually need to be there. But, to write policy and drive how this stuff can be utilized effectively, it's really young and it's tough. There's not a lot of 33, 35, 36-year-old policymakers out there that understand this stuff well enough to drive policy and be effective in that manner.
So to your point, what can be done? The Fed needs to cut rates and cut rates a lot.
Slash and burn, right? Yeah.
It's the only way to stabilize it, and they have currently the reason to do it, and they're not taking advantage of that.
Yeah, and we'll see. I mean, I think anecdotally, I think that I think again, you have that power, the nice separation of kind of the quote church and state between federal monetary policy and the legislative branches of the United States government, which I think is good to a point. But then when you have them starting to talk to each other and having one side try to tell the other one, which they shouldn't be able, typically aren't able to do something, it creates a little bit of friction right there for maybe what needs to be done versus what is actually going to happen. So we'll see how it plays out. It's tough. It's not. It's one that I'm anxious to see what's going to happen. But to the point of rate cutting, I think it'll happen. I just don't know if it'll happen soon enough.
Yeah, and if you look at the Fed's track record, it's pretty appalling. So keeping rates way too low for too long, waiting for so long to start raising rates so quickly it crashed the commercial real estate market.
Yep.
You don't
And
have
that
much confidence in them making the right decision, to be honest.
Yeah, and that's something that, we deal with a lot. And I've talked, almost ad nauseum on this podcast with a bunch of different commercial real estate developers, especially the ones that have been in the market for quite a while. It was hard for people to underwrite bad deals in the commercial real estate market in the United States. You kind of really had to try with how cheap money was for a long time. And it propped up a lot of people that didn't necessarily understand how to weather changing interest rate markets. And we're seeing that happen now with what's happening with the capitalization rates, what's happening with the ability to refinance, the fact that things like preferred equity structures for bailouts for these people are becoming more and more common, and larger investment platforms are looking and coming in and taking, bridge debt positions and preferred equity positions in that market. So something that I deal with a lot. So I can talk about that for hours, but it's interesting. And my concern with that is that if you cut rates, where does that if you cut rates, does that lead into another ability to prop up markets that need some healthy washing? I don't know.
Well, I think we just need to establish confidence in the regulators and leaders of the global reserve currency so they can do the job together and try and get it done before it's too late.
Absolutely. I think that's a very good place to end this off. I really want to thank you very much, personally, professionally, and forever, on this podcast. It's been one of the, I think, more enlightening conversations that we had, especially for people that wonder how all this stuff works, because it's not easy to understand, and having someone on that can really explain it in a digestible enough fashion. I know some of the stuff that we talked about here today for our listeners was technical in nature, but I really feel that it's, at its base is easy enough to understand, where people can really see what's happening, domestically, internationally, and understand, at least at a baseline, how this stuff works for you as the end user of someone that has US dollars or pound sterling in their wallet, right? So again, I really do appreciate you being on with us today, Ian. Any parting thoughts, or if people want to learn more and get more education? I know you said you had written a book or an ebook. How can they reach out and find that information?
So I've been writing a blog actually, which is on LinkedIn for the last 3 years. So it's a timeline and the beginning of the story of what's about to happen, whatever that is, where I can help people frame by exactly the conversation we've had today, to be able to understand some of the changes that are just about to happen before it happens to them, before it's too late.
Yeah, exactly. And again, understanding, for my 2 cents on it, all this can be, very frightening and overwhelming, but, making sure that you have good financial plans, making sure that you have the ability to weather instability is also important, right? Understanding what happens, how to prepare for it, and what you can do. Again, it's a lot of doom and gloom, but prepare, make sound financial decisions, educate yourself, understand what's happening with you personally, externally, and broader in the globe. It's all these things need to come together. And education is key in that. So yeah,
I'll leave you
definitely.
with one. Can I leave you with one thought?
Absolutely.
Is that people view financial market commentators to some extent as doom and gloomers, but nobody has the ability to be able to do that, because we're all dealing with money. We can afford no bias. If we think it's going down, that's because we really believe it.
Yeah, exactly. When the when the dollars are at stake, understand where the information is coming from, and just because it doesn't sound great doesn't mean it's not true. So
Exactly.
again, Ian, really appreciate you being on with us today. Everyone, thanks for listening. This has been another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.